Does buying an investment property here in Toronto even make any sense anymore in 2025? Well, that's what I'm here to help you figure out. In this video, we're going to do a very high-level analysis, both quantitative and qualitative, of an investment property that just sold in the downtown core about a week and a half ago, using 2025 numbers. And hopefully you'll be the judge of whether an investment property in Toronto makes sense for you. Let's jump right in. And remember, if you need help navigating this ever-changing Toronto real estate market, feel free to book a no-obligation call with our team below to see how we can help with your real estate needs. Okay, let's jump right into our quantitative analysis. I found this property, 115 Blue Jays Way, just sold 6 days ago, $452,000, okay? Let's take a look at the unit. It's living space, bedroom, kitchen, bath. Has everything you need, the basics, right? Here's the bedroom. $452,000, 115 Blue Jays for those of you who don't know. Fantastic location, right in the core of Toronto. You have the Rogers Centre CN Tower within like a 5-minute walk, right? Excellent location. So let's jump into our financial analysis. All right, so we have our purchase price. We have 452. Now the minimum amount you need to pay to buy something that's $500K and less is 5%. So let's assume 5% down payment. All right, that's cash on hand that you need, which means the remainder will be our mortgage, the amount we'll have to borrow, $429,400. Okay, cool. What happens when we buy an investment property? Well, there's cash inflows and cash outflows, right? Cash inflows would be rent. That's the biggest cash inflow, right? Let's see, what did it last rent for? It last rented for $2,250 in January 2023. I think the rental market has come down a little bit, but rent always fluctuates. So let's call it $2,200, right? I know we got leased for $2,250, but let's call it $2,200 because rent is down a bit, but rent will go up in the long term. But let's just call it $2,200 to be reasonable here. Cash outflows. Well, the biggest one will be our mortgage, right? $424,900. Let's put that in. $424,900. Is that what I said? 429. 400. 30-year AM. Right now, interest rates are looking at around the low fours. We are looking at $2,088 a month. Okay, what else do we have? We have condo fees. In this case, the condo fees for this unit are $368.96. We have our utilities are paid by the tenant, right? So what else do we have? Well, we have property taxes. Annually, it is $2,196. So let's prorate it monthly. It's about $183. And then we have home insurance. Now, your condo fees will cover the building insurance, and then the tenants have their own liability insurance, but homeowners need their own home insurance. Let's call it $50. And yeah, there's other costs, maybe like repairs and maintenance, but sometimes you can get lucky, like you can go all year without having to pay for repairs. They can be very minor, or you can have to buy a new dishwasher or something, but it's kind of hard to give a number. So let's, for simplicity's sake, skip it for now. Cash, and this is obviously monthly, everything is monthly here, right? So we're looking at $2,689, call it $2,700, right? So net cash flow is minus $489. Now, you might be thinking, hey, Ichi, what the hell, man? I'm losing money every month. How could this possibly be a good investment? Well, it's a good point, right? Imagine losing money every month. Seemingly, it doesn't make sense, right? But let's think about it for a second. Real estate is a long-term gain, right? And this is why private landlords, I think, are actually good, because if all these condo units were owned by corporations, rent's going to be even higher, right? It's like everyone's like landlords are greedy. Well, no, most landlords are actually losing money, which is why a lot of them are selling, which is why one of the reasons why prices are coming down, right? But that's a further conversation. How do we make this even better, right? Okay, we, in this first example, put 5% down. What happens if you put 30% down, right? Okay, then our down payment is going to be, instead of multiplying by 0.5, we put down 135,000 and our new mortgage will be 316,000. Rent will be the same. All of these other expenses will be the same. What's our mortgage now? 316,400. Same interest rate. Now we're looking at a monthly mortgage payment of $1,539. Bingo, cash flow. So our break-even point is somewhere just below 30% down payment. I know it seems like a lot, but trust me, for Toronto, relative to the last few years, we have not seen positive numbers like this. Can you get better cash flow elsewhere? Probably if you go to secondary, third markets outside of Toronto, but then your equity game is not going to be as good, right? So when you think of real estate investments, it's two things, cash flow and equity. I think in Toronto right now, maybe in 2015, the cash flow was really, really good, but for now, equity is the play in Toronto. You're looking for that long-term appreciation. It's that long-term game. The fact that you're even cash flowing is actually phenomenal. Really, right? You can cash flow in a smaller Canadian market somewhere else, but then is it really going to appreciate as much? And then you also have riskier tenants, right? Right now we're in 115 Blue Jays Way. This is like downtown Toronto. Like this is the human capital core of the entire country. You're going to get AAA tenants and it's going to be much less risky, right? So this is 30% down, assuming a 4.19 interest rate. Now, what's the biggest expense here, right? Well, it's the mortgage. Right now, the mortgage accounts for, in dollars, 71.88% of your total cash outflows. What happens when mortgage rates come down, which they will? Trump tariffs, all the banks are saying interest rates are going to come down. What happens if it comes down to like, you know, even a 3.5% on that? Well, now you're looking at 14.16, right? If I do 14.16, now I'm cash flowing almost $200 a month, right? And with rent, and obviously I could project this out like year 2, year 3, year 4, year 5, all the way out to whatever, discounted back, but I'm not. In this video, I'm gonna do a very, very high level analysis. I'm not gonna do a crazy discounted cash flow analysis. We'll save that for another video. This is just a very beginner friendly way to analyze investment properties. But let's take a look at some of these things, right? So the things you gotta ask yourself is, okay, I need to put down $135,000 cash. Can I find a better use of for my cash? Can I get a higher return in the stock market? Can I get a higher return in an investment property somewhere else? That's what you have to think. I don't know the answer to that. Maybe you can, maybe you can't, but real estate, relatively speaking, is quite safe, right? Rent. Do you think rent is going to go up or going to go down in the future? I personally think in 10 years, rent will be way higher than it is now, because by the year 2030, the number of new developments in terms of condos in downtown is going to be close to zero. There's not going to be any more supply. Right now, there's a lot of supply. So I think rent will go up, right? That might benefit your cash flow even more. But with that being said, your condo fees will go up, your property taxes will go up, and your home insurance will go up. Everything goes up, right? They just keep printing more money, right? So this plus this probably will net out. I think your rent will probably increase more than your condo fees and property taxes. Obviously, it depends on the building and depends on all that. But let's say it evens out. Again, the biggest contributing factor, the biggest variable here is that mortgage. Now, remember, real estate is a long-term game. What happens in, year 15, your mortgage, hypothetically, just hypothetically, comes down to 158. You've been paying down your mortgage for 15 years. Your mortgage is now 158,000. Well, assuming that this property is still worth 420,000, which in 15 years, it's probably going to be like, I don't know, I can't give you a real number, but it's probably going to be more than 450, right? 600, 700, I don't know, but it's going to be higher. And look, there's your equity right there. Even assuming the same price, if you were to sell this for 452 in the same price, but your mortgage had been paid down by half, you've just accumulated almost $300,000 in equity, right? It's the equity, not the cash flow, in my opinion, in Toronto. But the good news is the mortgage rates are actually coming down as well, right? And yeah, you'll be able to refinance your mortgage I mean, there's different ways you can refinance it. You can do the same 30-year, you can do a 15-year, so your mortgage rates will depend on the interest rate and what you negotiate with your lender at the time. These variables will go up. But like, if you're able to cash flow every month and someone else is paying down your mortgage, look at all this equity you're getting, right? And it's safe, in my opinion. What's the risk? The risk is, you know, you have, actually, you know what? Let's hold off on that. We are going to talk qualitative in a minute. This is a very, very high level overview of the quantitative analysis of an investment property here in Toronto. And like I said, I know the numbers aren't fantastic. They weren't what they were in 2015, but this is the best I think we've seen in this decade. The fact that you can cash flow is phenomenal. And it's why a lot of investors recently have been flooding into the market, especially with these predicted decreases in interest rates. Because look at this, 72% of your monthly cost is this interest rate, right? This is all affected by the interest rates. So yeah, this is a very high level overview. Again, we can project it to 30 years, right? It's a very high level. We're gonna keep it simple for this video. Let's talk qualitative. Now there's a lot of things that I've done a very high level analysis, right? For example, your cash, your rent that you collect, that's probably gonna be taxable income. Your taxes are gonna go up. But then on the flip side, mortgage interest, repairs, that's gonna be the tax deductions that you could use. So again, I'm doing a very high level quantitative analysis. Please do your own research. I wanted to keep this video as short as possible. Just a very beginner-friendly way of analyzing investment properties with numbers from today. Now, the other thing, qualitative factors. Even if you're going to analyze a company like Apple, for example, you're going to look at qualitative factors like, who's this Tim Cook guy? Is he Steve Jobs? What's his plan? You know, what's his story? You know, what are the geopolitics of entering into different markets? You can't always use numbers. You have to use your gut a little bit too, and it's the same for investment properties. So the number one thing is qualitative factors are very, very important. So one thing, rent control, right? Buildings built before November 15th of 2018 have rent control, which means you as a landlord can only increase rent set by the government Canada, right? And that's 2.5% typically, okay? 115 Blue Jays, the condo that we analyzed was built in 2020, which means there is no rent control, which means hypothetically, we can increase rent to whatever we want, which sounds like a good thing, right? But keep in mind, if you increase rent too high and the tenants leave, well, now you're gonna have to pay the realtors 1 month rent again to find new tenants. And it might sit vacant, which means you're gonna lose cash flow for that month. So it's good to always have a buffer. And that's something I didn't include in the quantitative analysis, right? Realtor fees. You're gonna have to include vacancy. And vacancy rates are very big. That's another qualitative factor. Like, okay, what is the vacancy rate in that place, right? If you are, ideally you get someone in there for 5-10 years, right? And they never leave and you never have to think about it, you just get rent every month and you pay your bills every month, fantastic. But what if the renters leave every month, right? That's another thing that you have to keep in mind, okay? And something that people often don't think about when it comes to buying an investment property, they just look at the numbers and say the numbers are great, but like the quality of the home will also affect vacancy rates, right? It's like a hotel. Put yourself in the tenant's shoes. If you were living in a spot and you're renting and you came home and there was always like, there's no view, or the space is small, the living space is small, there's a pillar in your living room, or like you're the landlord and the tenant has questions and wants things repaired and you ghost them, right? The tenant's gonna be pissed, right? And the quality of your home is not gonna be great, so then there's gonna be higher turnover. So a lot of these qualitative factors matter. You have to address the needs of your tenant. You're running a business here, right? Happier the tenant, the more likely they're gonna stay longer, which is a good thing for you. And the higher quality home, yes, is gonna cost more, but perhaps your vacancy rate will go down. So these are all qualitative factors that we have to consider. Another qualitative factor is the tenant profile. Okay, yeah, the numbers might be better if you look at other markets in Canada, secondary markets in Canada, right? Toronto is a different beast. It's the Manhattan of Canada, right? So prices are higher, cash flow. We have to put 30% down to even cash flow. That's a lot of money. No, not everybody has 135K sitting there, able to use to buy an investment property, right? So the cash flow is not as great, but what do you get? Well, Toronto, in my opinion, is the human capital area for all of Canada, right? There's nowhere like Toronto in all of Canada. The financial district, tech, everything is happening in Toronto. And if you think like me that's going to be the case going forward into the future, despite all the noise, Toronto's still going to be Toronto in 10, 20 years, then there's a good chance that the tenant profile of the market here in Toronto is going to be high. You're probably going to get AAA tenants applying for your home. So yeah, it's going to cost a little more, but AAA tenants are less risky. It's the same thing as like a bond portfolio, right? If you buy in a secondary market, in a smaller town, yeah, you might cash flow more, but you might have riskier tenants because who's actually living there? In Toronto, it's most likely young professionals, right? Especially 115 Blue Jays Way. It's all people working in the financial district, tech sector, lawyers, things like that, right? So that's another thing we need to consider. Can't really turn that and put it in a spreadsheet, but that's another huge qualitative factor. Always keep in mind who is the tenant profile in that market. What are the job opportunities? Are they going to be there in that market? And what is the general trend for that market? And in my opinion, Toronto's gonna be Toronto in 10, 20, 100 years, right? It's not going anywhere. So yeah, you're sacrificing a bit of that cash flow, but you're getting AAA tenants. Trust me, I've done a lot of leases. There are great people renting in Toronto, but take that with a grain of salt. There's always bad apples, but the risk is lower. It's all about mitigating that risk. Now, like I said, this is a very high level overview of investment properties in Toronto. You can go, I could spend hours looking at the numbers. I enjoy it. Not everybody does, but we can go way more in depth. We can project the cash flows out into a longer period of time. We can account for things that I didn't have time to account for this time. But there are three, I just want to keep it short, right? Qualitative, quantitative factors, very short video. But to wrap up, there's three basic ways that investment properties make money for you. One is the cash flow, which we found, right? Unless you have 30% cash down to buy an investment property in Toronto, even though the prices have dropped, even though interest rates have dropped, currently in March 2025, you need to put 30% down to cash flow, roughly, right? I think those numbers will improve. But that's number one, cash flow. But that's not everything, guys. There's also a thing called leverage, which you can't really get with stocks. You can borrow your equities on margin, I suppose, but then they can call it at any time and it's super risky. Mortgage lenders can't call your loan at any time, right? So leverage is something that is hugely not talked about when it comes to investment property. Why is that important? Well, just like a business, you want to be leveraged properly. You don't want to be over leveraged. You don't want to be under leveraged, right? So if you are able to take on a mortgage, that might not be a bad thing because A, you'll be able to borrow on that money, right? That's how people are able to snowball and buy like 10, 20, 200 properties because you're actually shown to be able to pay down debt. And also you have collateral that will allow you to borrow more money. You have cash flow that the bank looks at and says, hey, look, this is cash flow, you'll be able to borrow more money. So leverage is something that is vastly under talked about in terms of a benefit for an investment property. So leverage, keep that in mind. You can't leverage on equities, guys. Nobody does that. And not nobody, but like the average person should not borrow on their equity, right? It's unheard of. So leverage is huge. And number three, capital appreciation. I think we did a rough estimate, right? We said that assuming in 15 years that property is worth the same, which I don't think it will be, right? Average real estate prices, I think in Canada over the last 25 years appreciates at 4.5%. So yeah, it's not as high as like equities, for example. But yeah, you have the cash flow and the leverage, keep in mind, right? So let's say it appreciates at 4.5%. 15 years, that condo might be worth 600K. Right? I don't know the exact number, I'm just guessing here. And your mortgage for sure will be paid down. So if your mortgage is half of what it was, 150K, now your asset is appreciated, right? You're just paying down your mortgage, and the asset appreciates because those are the general trends of real estate. Generally, that's what's going to happen. Can't tell you the exact number, right? But then that difference, remember, real estate's a long-term game. That difference is going to be your equity, right? It just makes a lot of sense. So again, If you are able to play the long-term game, if you think that you can hold for a long period of time, then I'm gonna buy more properties myself in Toronto. But if you think that real estate, becoming a landlord is like a get-rich-quick scheme, ain't gonna happen. Just like being a realtor, like a lot of people join the real estate industry becoming realtors, being like, oh, I'm gonna get rich overnight. And then they realize, oh, wait a minute, it actually takes a lot of work, right? So it takes time, it takes patience. Now that's it for this video. Again, this was a very high-level, brief overview of how to analyze an investment property using numbers from today. Springtime, March 2025 in Toronto. The numbers will change. We can be way more sophisticated with our quantitative analysis, but I just wanted to give you guys the basics because I've been getting a lot of questions. I think a lot of investors are now being like, wait a minute, this might make sense. Prices are dropping, interest rates are dropping. It might start to make sense. Does it make sense for you? That's a different question. I can't tell you for sure, right? Maybe you look at these numbers and you say, wait a minute, we're cash flowing in Toronto? We haven't seen this in 2-3 years. Showtime, let's go. But maybe on the flip side, you're more risk adverse. Maybe you're thinking of having kids or going to university or doing a career change, and maybe bonds or something less risky is right for you, right? Even though I think real estate is still relatively less risky. Or maybe you look at this and you go, this is crazy. I'm gonna gamble all of my money in meme coins and try to hit 100 to 1, right? I don't know. It really depends on the individual whether buying an investment property here in Toronto makes sense. It really, really is up to you. I cannot tell you whether it's a good decision for you. Ultimately, you have to make the decision yourself based on your own risk analysis, your own risk tolerance, and where you think real estate will go in the future. So thank you guys for watching. Maybe in the future we'll go all the way to row column Z in the spreadsheet, and we'll do a full discounted cash flow analysis. But in this video, I wanted to keep it nice, short, and sweet for you guys. So hopefully you learned something. Again, feel free to reach out to me and my team below if you want more help in analyzing if buying an investment property is right for you. So that's it for this video. Thank you guys for watching, and we'll see you next time.